Marria Paula Muñoz. The following video shows the conceptual framework for financial information, comprehensive set of concepts for financial information in March 2018. This contains relevant information to take into account when preparing a financial report, concepts such as the objective of financial reporting, the qualitative characteristics of useful financial information, a description of the reporting entity and its boundary, criteria for including assets and liabilities in financial statements, between other concepts. Finally, this has as its purpose to assist the board to develop IFRS standards based on consistent concepts resulting in financial information that is useful to investors, lenders, and other creditors. Also to assist preparers of financial reports to develop consistent accounting policies for transactions or other events when no standard applies or a standard allows a choice of accounting policies. Okay, but why the conceptual framework has been revised? Really because the previous one, conceptual framework was issued in 1989 and have revised again in 2010 and lacked complete information, although it was useful. Priority identified as a priority by stakeholders in the 2011 agenda consultation. On the other hand, filling gaps, for example, guidance on measuring, presentation, and disclosure, updating, for example, the definition of an asset and a liability, and clarifying, for example, the role of measuring uncertainty, and as has a result, a complete set of concepts for financial information. Let's talk about the main change and improvements incorporated in the conceptual framework. In terms of measurement, concept on measurement including factors to be considered when selecting a measuring basis. In terms of presentation and disclosure, concepts on presentation and disclosure, including when to classify income and expenses in other comprehensive income. And in terms of the recognition, guidance on when assets and liabilities are removed from financial statements. Now, this report has several chapters where all the concepts needed to develop a financial report are dimensioned and what is its main objective. Users' decisions involve decisions about buying, selling, or holding equity or debt instruments, providing or settling loans and other forms of credit, voting or otherwise influencing management's actions. To make these decisions, users assess prospects for future net cash inflows to the entity, management, stewardship of the entity's economic resources. To make both this assessment, users need information about both the entity's economic resource, claims against the entity, and change in those resources, and claims how efficiently and effectively management has discharged its responsibilities to use the entity's economic resource.
Okay. Hi, I am Diego León. Chapter 2. Qualitative Characteristics of Useful Financial Information. This chapter discusses what makes financial information useful. For information to be useful, it must both be relevant and provide a vital representation of what purpose to represent. Relevance and fit weight representation are the fundamental qualitative characteristics of useful financial information. and the guiding concepts that apply through the revised conceptual framework, enhancing qualitative characteristics, comparability, verifiability, timelines, and understandability. TC for qualitative characteristics enhancing to the useful of information, but they cannot make non-useful information useful. Chapter 3. Financial Statement and Reporting Entity. This describes the objectives and scope of financial statement. This describes financial statement, a particular form of financial reports that provide information about the reporting entity assets, liabilities, equities, income, and expense. Consolidate financial statements. Provide information about assets, liabilities, equities, incomes, and expense of what the parent and its subsidiaries as a single reporting entity. Consolidate financial statements. Provide information about assets, liabilities, equities, incomes, and expense of the parent only. Combined financial statements. Provide information about assets, liabilities, equities, incomes, and expense of two or more entities that are not aligned by parent-subsidiary relationship. Chapter 4. The elements of financial statements. This chapter defines the 5 elements of financial statement: an asset, a liability, equity, incomes, and expense. Assets. The separate definition of an economy resource to clarity that assess in the economic resource. No, the ultimate inflow of economy benefits relation of expected flow. It does not need to be certain of ever likely that economy benefits will arise. Liability. The separate definition of economy resource to clarify that a liability is the obligation to transfer the economic resource, not the ultimate outflow of economic benefit. Income. Increased is asset of decreases in liability that result in increases in equity, other than to see relation to contribution from holders of equity claims. Expense. Decrease is assets or increases in liabilities that result in decrease in equity, other than to see relation to distribution to holders of equity claims. Chapter 5. Recognition and derecognition. Recognition is appropriate if it results in both relevant information about the asset, liabilities, equity, income, and expense, and faithful representation of used items, because that aim is provided information that is useful to investors, lenders, and other creditors. The recognition. The removal if all of part of the recognized asset of liabilities from entity statement of financial positions.
Okay, I'm Alex Tautiva, Misrem. Historical cost provides information derived unless in part from the price of the transaction or other events that give rise